Before you begin watching the Predicting Price series, I highly suggest you to first watch the model series and the trade breakdowns released. The reason why is because during this lecture series, I am speaking to someone who has already gone through those lectures, and therefore I anticipate the viewer to have a certain level of understanding algorithmic price delivery already. If you do not follow this guideline, do not be surprised if you do not understand the basics of everything that I will share. Enjoy this lecture series. Hello there, I hope that you are doing well. Welcome to the second lecture of the Predicting Price series. During this lecture, we will be discussing weekly profiles. The table of contents for this lecture are as follows. First of all, we are going to be discussing the weekly sequence. This weekly sequence is very important to understand when it comes to the weekly delivery of price. In order for you to anticipate what's likely going to happen throughout the week, you must understand this concept. So I want you to really pay some time to understanding it. Secondly, we will be discussing schematics. Thirdly, we will be discussing the economic calendar as a roadmap for the weekly delivery. And fourthly, we're going to be looking at some weekly examples. So with that being said, let us begin by looking at the weekly sequence. The weekly sequence is as follows. What I want you to understand is that Monday sets the stage for Tuesday's delivery, meaning how Monday delivers will have a great impact on how Tuesday is likely going to deliver. Tuesday sets the stage for Wednesday, meaning how Tuesday delivers is very important for anticipating how Wednesday is likely going to deliver. Wednesday sets the stage for how Thursday is likely going to deliver, and you can already anticipate what the final bullet point is going to be. Thursday sets the stage for Friday's delivery. Now the reason why I'm putting so much emphasis on these basic sequences is due to the following. What I want you to understand is that by understanding that the first day has impact on how the second day is going to deliver, you're able to determine in what environments you're likely going to find high probability trade setups and when not. Meaning, we look back at the current daily delivery to anticipate how the next daily delivery is likely going to take place. But here comes the thing, guys. We do not look at Monday in order to anticipate how Thursday, for example, is going to deliver. Or we do not say on Monday, okay, Monday consolidated, therefore Thursday is going to expand. No, we don't do that. What we do is we take it one day at a time, and that is how we move down the weekly sequence. Because you need to understand that you can try and predict all you want that we're going to see this weekly profile play out or that weekly profile play out, that Monday is going to form the high of week or low of week, or that Thursday is going to form the high of week or low of the week, or whatever scenario you can think of, right? But that right there doesn't matter. What matters is just that you can anticipate how the next day is likely going to deliver. Is it going to go higher? Is it going to go lower? Or is it going to go sideways? Keynotes are the following. Recognizing the higher time frame institutional order flow is crucial for being able to anticipate the delivery of price. Therefore, within this series, we are moving down from the higher time frames into the lower time frames. Because based on the monthly profile, you can anticipate how the weekly profile is likely going to deliver. And that right there is what I want you to understand. When you can determine the higher time frame institutional order flow, determining the drawing liquidity is only a matter of understanding time-based liquidity. Let me repeat that. When you can determine the higher time frame institutional order flow, whether it be bullish or bearish, determining the drawing liquidity is only a matter of understanding time-based liquidity. If you are bullish on the higher time frames, what you can anticipate is that we can look for previous cycle highs to be the drawing liquidity. If you're bearish on the higher time frames, you can look for previous cycle lows to be the drawing liquidity throughout the week. A previous cycle low can be, for example, let's say a previous daily low or a previous week's low. And if you're bullish, you can look for previous daily highs or a previous week's high, etc. What I want you to understand is that by looking at this schematic right here, you can see the monthly profile outlined where between the second or third week we form the high of the month. This gets confirmed because the market reaches a key level, and at that key level we see SMT taking place with a highly correlated or inversely correlated market. What's very important to understand is that the reason why I'm bringing back the schematic in this second lecture is due to the fact that when you recognize that for the monthly profile we are changing from buy program to sell program, From that moment in time, we can anticipate that we're likely going to see purchase of previous daily highs taking place, followed by reverts towards previous daily lows. If we pay attention then to what can occur is the following. If we understand that the smart money reversal is in for the month, we can look to target the opposing side of the range. The opposing side of the range can be, for example, let's say the previous monthly low. When we understand that we have changed from that buy program into that sell program, we will be looking at the reactions to the previous daily highs. You need to understand that the previous daily high is likely going to be a daily imbalance, a daily CB, its respective low. When we trade into that daily CB, its respective low, we anticipate that price is going to find resistance there and that we're going to expand lower. Or, in other words, we anticipate that rejections will take place of previous daily highs, where we purge them and revert towards the downside. This is the signature of bearish order flow. If we pay attention to bullish order flow then, what would look like is the following. Where we see the market draw towards the downside during the first or second week of the month. When we reach our higher time frame point of interest, our key level so to say, we see SMT taking place at this level. This occurs during the second or third week of the month. And this is all repetition of the previous lecture for monthly profiles for your info. The moment that we begin to see the market displace towards the upside, we know the following for the weekly profiles. We anticipate that every single time that we take out a previous daily low, that we're likely going to purge that low and revert towards the upside. Why? Because the higher time frame institutional order flow on the monthly profile has changed from bearish to bullish. Therefore, we can anticipate that the market is likely going to draw towards the opposing side of the range, which is this range high. This is our draw liquidity, as you can see. And you will see expansions followed by retracements, followed by expansions, followed by retracements into that direction. Because this is the draw liquidity on the higher time frames. Now you might be wondering, these schematics are very simple and you're probably like, how is this important for understanding weaker profiles? Well, you need to understand that unless you understand the monthly profile, unless you understand whether or not we're going higher or lower for the monthly profile, navigating the weekly profile will be very challenging. But when you understand where we are at relative to the monthly delivery, you can anticipate how the weekly delivery is likely going to take place. Meaning, we zoom out and we look first of all at what are the higher time frames telling to us. When we're able to frame a clear one-sided bias on that, we can move into the lower time frames to see if we can see the same signatures taking place that confirm that we are in fact going to draw higher, for example. If there is a difference between the higher time frames and the lower time frames, when it comes to your bias, you need to be very cautious. And I would suggest you to follow along with the higher time frame bias always and be cautious with trading against that. Now, as outlined prior, the highest probability trade setups are where we open low into a previous cycle low if the underlying order flow is bullish. We need to see a smart money reversal taking place below that previous cycle low, below that key sell side liquidity pool, and then we can anticipate that we're likely going to draw towards the opposing side of the previous cycle range, where buy side liquidity is resting. If we are bearish on the higher time frames, what we will be looking for is open high into a previous cycle high. We will be looking for a smart money reversal to form there, and then we can anticipate the market to draw towards the opposing side of the previous cycle range to target sell side liquidity. These are the two scenarios that we need to see. But you might be wondering, do we only target the previous cycle range its respective low? No. However, this is how you can easily frame setups. If you want to hold on to a longer term idea, you could target, for example, let's say a previous month's low, or you could target a previous year's low. What I'm showcasing to you in price, this schematic is price, and we're combining time by utilizing key opens. By paying attention to these key opens and the delivery of price around those opens, or from those opens I should say, and the AMD fractals, you are able to frame from the higher time frames all the way into the lower time frames what the idea is likely going to be. Basically, what is the delivery likely going to be moving forward. And unless that is clear to you, you need to sit and wait until it does clear up. And I want you to pay attention to the fact that I'm only annotating open low for bullish and open high for bearish. We will now be taking a look at some chart examples so that you get an understanding of how I suggest you to navigate the weekly profiles. What you can see right here is that I've annotated both Mondays as Tuesday's delivery. What I want you to see is that Monday was a consolidation. Please note, by the way, that these schematics are exaggerated in their delivery, and that is meant for educational purposes, meaning I really need you to understand that what I'm showcasing to you is that Monday consolidates right here. What I will be looking then for on Tuesday is the following. I will be looking for Tuesday to run towards the upside, to take out Monday's high, to take out these relative vehicle highs, and when Tuesday takes out that previous daily high, whilst the underlying order flow is bearish and I'm anticipating lower prices for either the month or this specific week, due to that monthly profile suggesting that, I'm anticipating that the run above that Monday high is manipulation, and then I anticipate that an expansion towards the downside will take place, and the first target would be the Monday low, meaning this is a Monday high purge followed by revert towards the Monday low. The expansion is into the real underlying direction. Now, if we pay attention to the bullish example then, what it would look like is the following. What it would look like is when Monday consolidates and we see relative equal highs and relative equal lows get engineered, notice that these highs do not necessarily need to be relatively equal or relatively equal on the lows. But you need to understand that what I'm showcasing to you is that when Monday consolidates, that sets the stage for a Tuesday open low if the underlying order flow is bullish on the higher time frames for an expansion towards the upside to take place. Because the fact that we trade towards the downside on Tuesday, yes, during preferably the London session, and we take out the previous daily low, that right there is manipulation which is taking place because we're anticipating higher prices for either the week or month to come. Therefore, we will be looking for an expansion into the real direction which is higher to take place. Notice that what I'm sharing with you here is an AMD fractal. Accumulation, manipulation, distribution. Again, let me remind you that if you do not understand what I just described to you, it's because you're too new to my mentorship and you should go back to the model series and learn the foundational knowledge from there, because I'm expecting that the viewer of this lecture already knows what AMD fractals or purge and revert models are. And that is why I'm going through this rather quickly, but I'm paying a lot of attention to making understand the delivery profile, the anticipation of how the next day is likely going to deliver, and these signatures that confirm to us that we're likely going to see a certain delivery profile take place. Now, if we pay attention to what can occur if we are in a very bullish market, if we see Wednesday expand, what we will be looking for is for the day to end with a consolidation. When the day ends with a consolidation, during preferably either the PM, so the afternoon, or Asia session, what we'll be looking for is for the next day to open up, to drop lower, taking out the sell side liquidity engineered below that consolidation. This is the manipulation for the day which is taking place towards the downside. Then we can anticipate further distribution to take place. This is day 1 expansion, day 2 continuation. Continuation of what? Continuation of the previous day's expansion towards the upside, meaning we anticipate that the next day is going to continue to expand higher. This right here occurs in very bullish markets, and the key signature to look out for is whether or not the higher time frame draw liquidity has been hit. Now, the fact that we consolidate to end the day of Wednesday is very important, so pay attention to that. If we would be looking at a bearish example, then we would first of all be anticipating lower prices for the higher time frames to take place, meaning we are anticipating the market to draw towards the downside. What we will be looking for is for Wednesday, the first day, to expand towards the downside and to end with a consolidation again. When we see that consolidation taking place, I want you to understand that we are anticipating that we are going to take out that consolidation its respective high, meaning we're going to purge this time-based liquidity, and by purging that time-based liquidity, which is usually either the afternoon session its respective high or the Asia session its respective high, by purging that buy side liquidity, Smart money is provided the opportunity to go short again to target the real draw liquidity, which is below market price, as you know. This is a purge and revert model again, but this is within the overall daily delivery profile. It is day one expansion, day two continuation. Day two continues the first day's respective expansion towards the downside. This again occurs in very bearish markets where we're anticipating a lower target to be reached on the higher time frames. Now, if we pay attention to another delivery profile that can occur, then is the following. This is day one expansion, day two retracement. What you can see here on the left is that I've showcased the delivery of Thursday and the delivery of Friday. What I want you to see is that Thursday opens up, runs higher, and then expands towards the downside. What I need you to see then is that Thursday forms the daily low right here. We see retracement taking place. Friday opens up. Friday initially runs lower, but eventually reaches our key level. This is our weekly drawing liquidity. When this weekly drawing liquidity gets hit, what we'll be looking for is signatures that confirm to us that we're likely going to turn around. What can we then anticipate to be the next strong liquidity if we're in fact going to turn around and change from sell program into buy program? Well, what we can easily anticipate is that we're likely going to draw towards equilibrium of the range which had been established between the high of day on Thursday and where we anticipate to be the low of day on Friday. That is our easy drawing liquidity going into Friday then. Basically what we're doing is we're trading the retracement into this range which got established by this expansion towards the downside into that high time frame key level. Please be mindful of the fact that what I'm showcasing to you, these schematics, yes, they are not day specific. Meaning, what I need you to understand is that I've annotated Thursday and Friday right here. But this could also be Wednesday and Thursday. This could also be Tuesday and Wednesday, for example. All that matters is that you understand day one expansion, day two retracement. Retracement into what? Into the first day's expansion. And that is what I want you to see within this delivery. Now, if we pay attention to the bearish example, what I want you to see is that on day one, which is Thursday, we expand towards the upside. The market draws towards this higher time frame key level. When this higher time frame key level gets reached on Friday, we see the signatures that confirm to us that a swing high is forming. What can we then logically anticipate to be the strong liquidity to end the week in this case, because it's Friday, or to end the day? What we can anticipate is that when that swing high formation gets confirmed, that IPDA will seek to reprice back into equilibrium of the range that got established during that expansion higher. Meaning what we can anticipate is for the market to draw towards equilibrium from the range from this low, which is Thursday's low, to the high which formed inside of our point of interest, our higher time frame drawing liquidity. The economic calendar is a roadmap for navigating the weekly delivery. As you know, I use Forex Factory as the roadmap every single week within my weekly analysis, meaning I share with you based on the economic calendar what days I'm interested in and what sessions particularly. You need to understand that the economic calendar provides us with great insight for how the upcoming week is likely going to deliver and what days are likely going to be very choppy or very clean. When you understand this, it of course makes sense for you to focus on the days that are likely to be clean. Those are the days where you can find nice low resistance liquidity runs. The days that are likely going to be messy, you can anticipate high resistance liquidity runs to take place. And that is of course not the type of environment you would like to engage in. First of all, we will be looking at NFP weeks. Basically, I'm going to walk you through the different weekly profiles that can take place based upon the economic calendar, and I will share with you how we would navigate them. Here we can see the NFP week. As you can see, on the final day of the week, on Friday, the NFP release took place. Therefore, going into this week, you must understand that our focus is initially on the first few days of the week, meaning our focus is from Monday till Wednesday's morning session. Meaning we'll be looking at the markets from Monday right here till Wednesday's morning session. The reason why we focus on these first 3 days of the week during NFP weeks is because of the fact that we anticipate that the majority of clean moves will take place between Monday right here till Wednesday's morning session. After Wednesday's morning session, we anticipate that we're likely going to see range-bound delivery in which liquidity will be engineered that can be targeted during that NFP release on Friday. On Thursday, we will not look to do anything because it is the day in advance of NFP. Our focus will be on waiting how NFP is going to deliver. When NFP has delivered, we will wait for at least 1 hour before we can determine what's likely going to happen next. Meaning we wait until 9:30 a.m. has passed before we can look for any setup. In NFP weeks, this is the schematic which I utilize every single week. Meaning I focus on medium and high impact news from Monday till Wednesday as I outlined. On Thursday, I anticipate a range bound day and I will not look to engage on that day. Friday, we have NFP and I anticipate a large range day for this particular day. If you can get in sync with this usually provides for very clean expansions. Now, if we pay attention to what could occur inside of a very bullish environment in an NFP week, what it could look like is the following. What it could look like is where the new week opens up and initially drops towards the downside on Monday. What you can see is that on Monday we form a low and we begin to expand towards the upside. This usually takes place when there's high impact news on Monday, which is allowing for this expansion to take place. When this expansion towards the upside to take place, we will be monitoring whether or not we are going to consolidate going into the open of Tuesday. When Tuesday opens up and we see it run out the consolidation in its respective low, which took place during Monday's delivery, we want to see a purge and revert taking place. Meaning we want to see the market take out these relative weaker lows and we want to see it begin to expand towards the upside. Again, near the end of Tuesday, we will be monitoring whether or not a consolidation is likely going to take place. This consolidation engineers both buy side above the highs as sells liquidity below the lows. Wednesday comes along and we see Wednesday initially drop towards the downside. We see it drop lower. What I need you to understand is that this drop lower right here is trapping people into believing that the lower prices are next. However, as outlined, this is a very bullish week in which we're anticipating higher prices to take place, meaning we're anticipating an expansion towards the upside to take place. Therefore, this drop lower has one function, and that is to engineer buy-side liquidity resting above these highs. The market will seek to draw towards those relative equal highs. When the market takes out those highs, we will be anticipating that the market will go into a range-bound profile until the NFP release. Meaning we will be anticipating that we are likely going to go back and forth on Thursday to engineer liquidity so that when the NFP release takes place, the real move can begin. And here comes the most important thing which I need you to understand. Even though I shared with you that we were bullish on the higher time frames for this schematic right here, for this delivery profile for the week, I need you to understand that we will not stand in front of NFP. Because if our read on the weekly profile was wrong and we're not going to draw towards the upside, NFP is likely going to be very bloody and you're going to be caught off guard then. NFP is something which you do not stand in front of, meaning you do not stand in front of the news release which takes place. If you do try to stand in front of the news release, you are going to find out the hard way and it's not suggested for you to go down that path. Don't be a gambler. Meaning, I want you to really think about it logically. Is it really worth risking all of that mental capital by trying to participate in such a quick move where usually manual intervention takes place? Of course, the risk is not worth it, and the reward also not, because you might get it right once, right? And you might make awesome profits. But do that month in, month out. You will see that NFP cannot be predicted, and therefore you shouldn't try to stand in front of it. With that being said, you see NFP gets utilized to reprice towards the upside and eventually the high of week forms on Friday. This occurs in very bullish markets, but I want you to understand how just within this overall weekly profile, I broke down to you how we refer to the previous day's delivery to anticipate how the next day is likely going to deliver by paying attention to the previous day high and the previous day low. Now, here I've overlaid the schematic which I already showed you when it comes to the overall anticipation for the week. I want you to see that between Monday to Wednesday, we anticipate the cleanest runs to take place. Thursday, we anticipate the chop range bound day. This is a good day to take off and to study. And on Friday, we anticipate a large range day again due to that NFP release, which will take place. We are now going to take a look at CPI weeks. What's very important to understand is that for CPI weeks, CPI doesn't always take place on the same day each week. Therefore, you must understand that every single week where there is CPI, CPI can take place on multiple days. In this example, you can see that CPI took place on Thursday. If we pay attention to what we can then anticipate for a CPI week, it would look like the following. If there's a lack of medium or high impact news on Monday, we anticipate a range bound day. The same applies to Tuesday. If we see CPI taking place on Wednesday, we anticipate that on the CPI day, we're going to have a large range day. And now you need to understand that after small range days, we can anticipate large range days to follow. Therefore, you must be able to navigate the economic calendar like I'm teaching to you. Because on a small range day, we look to engage in a different manner than on a large range day. If CPI takes place on Thursday instead of Wednesday, we look for Wednesday to also be a small range day unless there's high impact news. If there's high impact news that's significant, we can anticipate Wednesday to be one-sided as well. The day after CPI is usually very clear with clean order flow. The reason why is because CPI usually sets the stage for the remainder of the week to deliver, meaning Thursday's afternoon session and Friday's morning and afternoon session are likely going to be clean. If we pay attention to a CPI week where we are anticipating lower prices for the week to come, it could look like the following. Where there's no high impact news on Monday and Tuesday, so you just see range bound delivery, where you can see the market go higher initially, run lower, and then retrace into the daily range established. Same applies to Tuesday, where you can see the market run higher early on in the day, expand towards the downside, and then eventually go into the close. Notice that the delivery between Monday and Tuesday is just a range-bound delivery. The reason why this is important is because we are waiting for that CPI release. We are waiting for that news to come out. At the moment that news comes out, we can anticipate the one-sided order flow to step in. What we can see is that on Wednesday during the London session, there's not much that happens, meaning the market just goes back and forth. Why does this occur? Because the CPI release will take place during the New York morning session. When the New York morning session then comes and we see CPI reprice higher whilst we're anticipating lower prices, we look at the delivery higher as manipulation, meaning we anticipate that the run higher which took place during the CPI release is like manipulation, which we can then utilize to anticipate distribution from 9:30 onwards towards the downside. If CPI reprices into our anticipated direction, we must anticipate a continuation day to take place. I hope that you're paying attention to the words that I'm using and the if this then that statements. We have the subtitles on these lectures, so therefore you should clearly make screenshots of certain if this then that statements, because I hide them in between these lectures and you're able to pick up massive gems from there. What I want you to see then is that on Thursday we expand towards the downside because that is the higher time frame order flow, and then on Friday we retrace back into the weaker range because our higher time frame draw liquidity for the week has been met. And now what I want you to understand is that I'm combining the logic which I described to you based on utilizing day 1 and day 2, meaning based on day 1 we can anticipate how day 2 would deliver. We can apply that logic within a weekly profile as well when there's a high impact news driver such as CPI. Here I've annotated the boxes as well, and as you can see, these line up perfectly with the delivery that if there's no medium or high impact news during those first 2 days in advance of CPI, anticipate range bound days. On the day of CPI, we anticipate a large range day, and the day after CPI or the real CPI day, we anticipate again a large range day. The final day of the week is likely going to be a retracement into the weaker range if we saw an expansion taking place towards our draw liquidity for the week. We anticipate clear one-sided order flow even if this goes against the overall idea which we had early on. Meaning if we were bearish throughout the beginning of the week and eventually reach our draw liquidity, from that moment on we can anticipate a reversal or retracement to potentially take place. Meaning we were initially looking for shorts throughout the beginning of the week and eventually our draw liquidity gets reached and we look for longs. Now if we pay attention to FOMC weeks then, what I want you to see is that FOMC days usually take place on Wednesday. They always occur during the afternoon session. What is very important to note is that FOMC is a two-stage delivery event, meaning with high impact news being at 2 p.m. and at 2:30 p.m. Usually the movement which takes place between 2 to 2:30 p.m. is the majority of times manipulation. The real move begins after 2:30 p.m. That is where our focus has to be on the day of FOMC. Pre-FOMC, we anticipate range-bound delivery, regardless of whether or not there's high-impact news. The reason why is because FOMC is a very significant high-impact news driver, and we anticipate that in advance of that news release, we are likely going to see the market engineer liquidity. Is it possible that we are going to see large ranges get established in advance of FOMC? Yes, but then the morning session of FOMC day is going to be very choppy. Meaning in this example, you can see that pre-FOMC, we anticipate range-bound delivery. On the FOMC day, we anticipate AM chop and PM expansion. We never look at the morning session of FOMC days. That is a morning session which you can just sleep in on, meaning you can just skip it basically. Our focus is after the FOMC release. Post FOMC, meaning on Thursday and Friday, we can anticipate very clean one-sided order flow to take place within our overall weekly profile, because there's no high impact news of such significance waiting for us that could be a limiting factor for IPDAT not to deliver and consolidate. But because everything is all clear, we can anticipate that we're likely going to see nice one-sided order flow afterwards. Now, if we pay attention to what an FOMC day could look like the following. Where we see, during the beginning of the week, the market slowly begin to grind towards the upside. Notice that in this example, we're anticipating higher prices. We grind slowly towards the upside, as you can see, and the market begins to consolidate, and range-bound delivery takes place between Monday and Tuesday. On Wednesday, this range-bound delivery continues during the morning session, and then the FOMC release takes place. We initially run lower, taking out these relative weak lows, and then we begin to expand towards the upside. We begin to draw higher. This movement higher, yes, is the real move which is taking place, which is to be anticipated because we're anticipating higher prices for that overall week into our drawn liquidity. After the FOMC release has taken place, we can anticipate the clean order flow as we are used to seeing it, or as we want to see, so to say, where we open up on Thursday, drop lower, taking out sell-side liquidity before expanding higher, creating the high of week, where Friday retraces into the weaker range established, targeting sell-side liquidity. Now, with a regular week, the week would look like the following, where we see that we begin the week with a bank holiday. Not every single week begins with a bank holiday, but even if we have no news on Monday, these are type of days where you want to be cautious. On Tuesday, we can see that there's medium impact news for the dollar at 8:30 a.m. and we have medium impact news for the euro and GBP during the Wallen session. But for now, I'm focusing on the dollar. What I want you to see is that at 8:30 a.m., we have that medium impact news, and that is the only economic driver which is scheduled. Therefore, we must focus on the 9:30 open to see if there's an opportunity afterwards. If 9:30 does not deliver in a clean way, we anticipate chop to take place. If we see 9:30 clear up and we see one-sided order flow stepping in, we can anticipate clean order flow to take place for that day, regardless of the fact of whether or not there's any high impact news. On Wednesday, we can see that during the London session, there's GBP, CPI release, and we can see medium impact news for 2:40 p.m. at the euro. Now, what I want you to understand is that Wednesday is also a day without high impact news for the dollar. Therefore, our focus is again on that 9:30 news and how we will trade relative to Tuesday's range. Because Monday was a bank holiday, we do not have any expectations for Monday. It's likely going to be a very choppy day with a lot of back and forth going and time distortion. Therefore, we begin the week by paying attention to, okay, where's the Monday open? How did Monday deliver? But we're paying mostly attention to how Tuesday delivered. Based on how Tuesday delivered, we can anticipate how Wednesday is going to deliver. What you can see is that during the second half of this week, from Thursday on, that is where the news begins to kick in. You can see that at 8:15 a.m. we have high impact news for the euro, 8:30 a.m. unemployment claims, 8:45 a.m. ECB press conference for the Euro high impact news, medium impact news at 11 a.m. and at 3 p.m. What I want you to see is that because we have news at 8:30 a.m. on Thursday, we will be monitoring how they're going to run with this 8:30 news. If this 8:30 news will be used for manipulation purposes, we can anticipate that 9:30, which is the next key open, is likely going to distribute. If the morning session is clean on Thursday and one-sided order flow begins to step in, we can anticipate that this will continue throughout the afternoon session. On Friday, we can see that we have high impact news at 2 a.m. for the GBP, and we have medium impact news for the DOR at 8:30 a.m. and 12:10 p.m. Again, a day without any high impact news. Sure, we have that medium impact news, but we do not have any high impact news. Therefore, our main focus is on that 9:30 open to see how we will utilize that to either manipulate or distribute. The regular trading week looks like the following if there's a bank holiday. The bank holiday we anticipate chop. If there's medium or high impact news on Tuesday, we anticipate one-sided order flow, and the same goes for the remainder of the week, as you can see. The main focus is on determining whether or not there's any medium or high impact news and utilizing the weekly profile as discussed. What this could look like is the following, where throughout the beginning of the week, we can see that the market consolidates on Monday due to that bank holiday. Tuesday comes along and we begin to see the market run towards the upside and begins to engineer buy-side liquidity near the end of the day. Wednesday comes along and we initially drop lower, taking out sell-side liquidity. We then have one more push higher to take out the previous day high, form the high of day there, and then begin to displace towards the downside. Now on Thursday and Friday, we anticipate that we're likely going to draw into the weekly range from the weekly low or the current weekly low to the current weekly high. That is basically a regular trading week described based on delivery profiles, where we focus on that 9:30 open to see how 9:30 is going to deliver if there's a lack of high impact news. If there's high impact news, we focus on how the high impact news will get utilized. Will it get utilized for manipulation purposes or will it get used for distribution purposes? To summarize this lecture, I want you to understand that understanding the weekly profile is not about predicting where the high end or low of the week will form. Understanding the weekly profile is about understanding the delivery relative to each previous day within a higher time frame analysis. Meaning, if we are bullish on the higher time frames and we're anticipating higher prices, every single time that we see the market reject a previous daily low, that's a sign of more strength to us. If we would see the market fail to displace above a previous daily high once trading above it, and instead rejects it, that's a warning sign. And that's a very simple example of how we can navigate the weekly order flow day by day. I hope that you enjoyed this lecture. The next lecture is going to be about daily profiles and how we can incorporate the trading sessions within them. I look forward to speaking to you in that one. Be safe.